Hi friends, I welcome you all to the monthly market outlook. In what we have been repeating over the last few months, that Indian economy is like oasis in the global desert. But there is a message, and the message is that there is a standstorm which is blowing globally. Now let's look at the headlines. The headline numbers by and large have been positive for India, except that the retail inflation has picked up and the e-way bill have declined from their peak. Apart from that, the currency with public rises, uh, to the 71% within 6 years of demonetization. Except this three things, rest of the headlines look positive. If we look at the high frequency indicators of PMI or e-way bill or industrial activity, all of the numbers are heading towards green trajectory. The capacity utilization is now at a 17-quarter high. It is well above pre-COVID level. Economic activities are 25% higher than pre-COVID level, as you can see. The credit growth is reviving and touching into double digits. And it's just not only for non-food credit at about 17%, but also for retail loans and personal loans at about 19%. No wonder India has become the highest and the fastest growing major economy in the world for last year as well as the current year, and it is likely to continue in the next year. This will be the first 3 years where India will be the fastest growing major economy in the world. GST collections are consistently remaining above 1,40,000 crores for about quite some months, and this has exceeded the budgeted estimate by about 3 lakh crore for FY23. The e-way bill generation, which was steadily going up since 2021, has witnessed a steady bump in October 22, and this is a cause of concern. This might be something that we need to look, and perhaps this might cause some worry, but let's see what holds in the future. In this festival season, there was hope that consumption will take off. The numbers have not yet arrived in totality, but at least the survey did suggest that 36% people were looking to spend more money than last year. About 21% odd people were going to spend less than last year, and 30% odd people were going to spend the equal amount of money they did last year. There is also an increased level of borrowing to spend money. Now, there are people borrowing because they are desperate, or are people borrowing because they are confident about the future. We'll have to wait to see, and we'll have to rely on the data for the hypothesis. Good news about India is correction in oil prices. They went down about 26% since March 22, high to double digit, but it is still in the 90 wala handle rather than 70 handle, where we can be comfortable. Clearly, oil prices are driven more by what happens through OPEC catalyzation. There are expectations that US and Europe will go into recession, and let's see what it holds. In past, whenever US has gone into recession, it hasn't impacted India materially, except maybe 2020, where the drop in Indian GDP was more driven by COVID than by US recession. India continues to run at a very large amount of deficit. We are importing more than what we are exporting. The run rate has moved from about $30 billion a month to $25 billion a month. But still, overall, our trade deficit is likely to result into balance of payments deficit of about 50 to $60 billion. And we agree that this amount is not a small amount. This much money will have to fund by selling our reserves. In the trade deficit, the biggest contributor is our trade deficit with China. This year, our imports are likely to touch about $100 billion exports, and this might be, and what we are exporting is about 13 billion. So we are importing around 100 and we are exporting around $13 billion. So we'll have an annualized run rate of about $87 billion with China in terms of deficit. And this clearly is unsustainable at this level. One thing for India will be how do we increase our exports market share today. Today in merchandise trade, we have about 1.7 to 1.8% market share. In services, we are about 4% market share. So the question is that how are we going to increase that? We are hoping that by 2030, we will be able to increase our services market to 6.4%, merchandise export market share to 3.5%, and the combined market average to be around 4.5%. Clearly, exports will be the biggest driver for growth in Indian context, and achieving this number, we will not just be the back office of the world, but also we want to aspire to be the factory to the world, which is very critical. If we come to the market side, there has been significant correction in US tech giants. The top 7 US tech giants have crashed more than the market cap of India. Let me repeat that again. The top 7 US giants, as you can see, Microsoft, Alphabet, Meta, Amazon, Apple, Tesla, Netflix. These companies have crashed more than the market cap of India. The largest losses have been absorbed by these companies. The foreign portfolio investors in India have generated a reasonably good rate of return in India since 2005. Their IRR is more or less about 8% in US dollar terms. Now, this is one WhatsApp forward which said that whenever Fed is hiking interest rates, Nifty continues to climb the ball of worry between Fed's interest rate hike by 75 basis points in June 2022. All the way up to November 22, Nifty has moved from 15,700 approximately to 18,000. If we look at Indian market performance vis-a-vis with the US, it is invariably linked to the earnings growth in 2010 to 2010. Indian companies' earning growth was about 14 odd percent, and MSI India return was at about 12%. In the same time frame, US companies' earning growth rate was about 2%, and equity market delivered -1%. In 2010 to 2020, US companies grew earnings by 8% and S&P delivered 11%. Whereas the MSCI India did not deliver any return. And if we combine both the data of 2020, then you can clearly see that the earnings growth and the stock market returns over a 20 period kind of converge. MSCI India has massively outperformed the MSCI Emerging Market. MSCI Emerging Market 10-year CAGR is negative, 5-year is negative also. The MSCI 10-year CAGR is negative, 5-year CAGR is also negative. And the same period, India has delivered with single-digit return. Our weightage in MSCI emerging market indexes on the rise from about 8% in March 2020. Now we are at 16%. So we have just doubled our percentage stake. Our weights have gone up as our markets have delivered positive return. Rest of the world's weight has come down as their markets have delivered negative returns. India continues to deliver better return than its peer in last 8 years. We have delivered around 9 times more return than emerging markets. In last 12 years, we have delivered 3 times more return in the last 12 years, and around 20 and over 20 years, we have delivered 1.5 times more returns. Our valuation premium continues to remain at a higher level to emerging markets. Historically, we traded about 40 premium to emerging markets. Today, we are at 86% premium compared to emerging markets P ratio. And compared to the emerging market P ratio, we are at about 149% premium. Undoubtedly, Indian markets look expensive on 1-year basis vis-a-vis with the rest of the emerging markets. Now, this is a very important slide. The driver for the Indian equity market is the domestic investor. In the past, whenever whenever the FIIs used to sell our market, used to correct big time. It happened in 2008. It happened in the subprime 2008 subprime crisis. It also happened during paper tantrum. But in the last 1 year, despite the selling of 48,000 crore, uh, and in and despite selling 2 lakh crore in last 1 year, the retail investors have managed to put in more money than the money that has been taken out by the FPIs. FPIs now have turned marginal buyers from the month of July. It looks like they will continue to be buying India as they have realized that this is one market where they have booked their profits and they have invested in markets which are giving them losses. It has now dawned upon to the FPIs that India provides better earning growth opportunity over a longer term, better governance standards, and also green return with conscious for environment. Maybe they will make a U-turn and start investing in India. Now, do remember that markets are very, very difficult to predict. I'll share this as an example. There has been this WhatsApp message which has been circulated about this particular stock called Carvana company. There was a target by Morgan Stanley that this stock is currently, this stock is going up to the target of 420, but currently this stock is trading at $7. So this is just to put things into perspective that it's not easy to predict the markets. Now coming to the valuation wise, Indian markets are at marginal premium to its fair value. Historical P is at 18 and a half, and we are at 19.6. Historical PE is 2.7, while historical PB is 2.7. We are at 3.1. We are trading at marginal premium to our own historical averages. From a market to GDP ratio, there was a time when global market cap to GDP ratio was higher than India. Now it is reversed. Global market capital GDP ratio is 98 and India's market capital GDP ratio is 107%. It's almost 10% premium over global market cap. Our own market cap to GDP ratio at 107% is higher than historical average of 79%. Undoubtedly, Indian market on a 1 year basis looks expensive. The result season for large companies by and large is at our expectations. 26 companies have delivered better than expected performance in terms of sales, but only 7 companies delivered better profit than expected. The earning downgrade upgrade ratio is more than 1 at 14 to 24, which shows that results are by and large in line with the expectations. India's outperformance in recent months is driven by the banks. As banks bounced back, it has actually pulled back the India's performance. Now, what will FPI do going forward? Many FPIs have said that they would likely to be underweight India as it is trading at premium valuation to the global peers. So with this, I would end this presentation because the FPIs are not sure and there are certain ups and downs. I would say that there is volatility and one should be ready for the volatility that is going to be present in the market. Thank you and have a great month.